What's going on, my friends? It's Brennan here, and I'm going to continue this video series on teaching you guys things I've learned from my journey that can hopefully help you with your journey. Now, if you guys are liking this series of videos that I'm creating on my channel, let me know in the comment section, and if I get enough people that like it, then I will keep on doing these videos. And I know I said that last time, and I'll probably say it many times on in the future, but really, speaking quite frankly here, these videos do not make me really any money. They make me like, I don't know if I can speak about my AdSense earnings, but maybe like a couple $100 per month in AdSense income. So the only reason that I'm really creating these videos is because I'm hoping that maybe you can take something from them that you can apply to your own life. Now, in this case, I'm not going to be creating a video to talk about how to make a bunch of money online. What I'm going to talk about instead is how to take the money that you have and turn it into relatively passive income offline. So how do you invest the money that you make from online, from your job, or from different sources? Even if you don't have a ton of money, how do you use that money most effectively to make the biggest amount of cash passively as possible? Now, I know a lot of people look at online income as passive income, and 100% you can create passive income online. But I tell you what, offline income can be way more passive than online, especially if you set up your investments the right way. Now, there's a million different ways to invest your money, but there are two main ones that most people go to. Now, there's different options. We'll talk about some of that other stuff in this video as well. But really the two main options, the first one is obviously stocks, the stock market, investing in different companies and buying shares. Or the second option, which is my preference, is real estate. Now, to give you an idea here, guys, a stock market, if you pick blue chip stocks, so blue chip means companies that are reliable to increase in profits. So, for example, banks are always making good money. They're usually blue chip stock options. Companies like Apple, for example, and Microsoft, those are major, huge companies that are constantly growing. And for that reason, they're considered relatively safe investments. Now, if you're going to pick stocks, you want to pick something that's a safe investment in the blue chip category that also pays out dividends. And in a nutshell, dividends means that every quarter, the company actually distributes cash to their investors in the form of dividends. So it's actually profits from the company that they give to their investors. Now, that's the best option if you want to go with the stock market, and you can expect, this is not financial advice or anything like that, but generally, 7 to 8% return on your money, pretty much passively, if you go the blue chip stock route. Okay, and different people are going to result differently at different times, but that's kind of like a general idea. Now, the real estate market, on the other hand, which is my preference, you can easily get a 20% per year return on your money because you're taking advantage of something called leverage. Okay, now, what does leverage mean? Okay, well, if you take out your credit card, I don't know if I have a credit card. No, I have a baggage tag. But let's pretend this is a credit card. So if you take your credit card, where's the power of your credit card? The power is not, what is the value of money? I guess I put it that way. What is your money worth? At the end of the day, your money is a piece of paper, okay? It by itself has no value. If you got lost in the woods and you couldn't find your way out and you were super cold and you had a bunch of cash, there's a good chance you'd set your cash on fire to keep you warm because money in and of itself doesn't have intrinsic value. The value of money is in what it can get you, what it can buy you. Now, when it comes to real estate, generally, you can put on a property, when you buy, you can put only 20% of your money and 80% of other people's money. Now, there's ways around this. You can actually do less if you have usually like mortgage insurance or you have like special rates from the government or something like that. But generally speaking, 20% is kind of a normal down payment. So when you buy a house for like $600,000, Your amount of money into the house is only around 120, 130,000 plus closing fees and all that kind of stuff, which we'll talk about in a second here. Now, that means that if the value of the property goes up by 3% in a year, which is a normal appreciation, you are getting 3% on the total value of the house, which is 600,000, even though you only put in 120,000. So you are appreciating that property by 3% of 600,000, which is 3,000 times 6, which is, what is 3,000 times 6? What is 3,000 times 6? 18,000. So the house is going to appreciate by 18,000, but you only put in 120, 130,000 in. So right there on appreciation alone, you're getting a 10% return in equity from the appreciation of your property, just on the appreciation alone from the compared to the money that you put into it. You know, I just bought a multifamily property, and I can realistically get, you know, $30,000, $40,000 cash flow per year on that property. First of all, you got your appreciation, which is going to be relatively in line with inflation, around 3%, maybe less, maybe more, depends. Then you got the cash flow, which hopefully you're getting a decent amount of cash flow on, but you'd actually be surprised, depending on the area. You might find more return in the other variables than you do in the cash flow, and we'll talk about that in a second. And then the third return is that you're actually paying down the mortgage. You're actually paying down the money that you owe. Okay. So for example, if I have that house for 600,000, in the period of 5 years, I will have paid down around $50,000, $60,000 in principal. Okay. So that $50,000, $60,000 that I paid down is money that is now stored in the property. That is now my money that I can pull out of the property. So for a 600,000 property, we invest 120, 130, maybe 140 after closing fees and all that kind of stuff. We're going to generate on average per year more or less about $18,000 worth of appreciation. Maybe we make around, you know, $12,000, $15,000 in cash flow from our real estate because we're renting it out. And finally, we're getting about $10,000 to $15,000 that we're paying down on a per year basis on our loan. So when we add that together, the 10 to 15,000, we add that together with the 18,000 appreciation, and we add that with the $15,000 cash flow, we are getting about a total return of around, I don't know, like $45,000 worth of total return when you take into account the appreciation, the cash flow, and the actual pay down of your loan. So that means that we invested for about 120, 130, 140, and we're getting 45,000 return per year on our investment, which means that our total return is well over 20%. Now, what can we do with this? Well, when our mortgage term ends, we can now do what's known as a refinance with the bank. Typically in the States, I think you have really long mortgages. In Canada, you get only 5-year term mortgages. So when the 5-year ends, you actually renegotiate a different mortgage. So when that 5-year period ends, I now can refinance. I can take all of that $50,000, $60,000 that I've paid off onto my loan. I can take that money back in cash and not even have to pay tax on it, which is kind of crazy. And now I have the $50,000, $60,000 in cash that I can go fund another real estate deal or whatever with. Now, what you can do in addition to that is if the value of the house goes up, you can get a new mortgage that's assessed to the new value of your house. So if your house is appreciated by $100,000 in those 5 years and you've paid down $50,000, $60,000, now you can pull $150,000 or $160,000 out of the property when you're refinancing. And think about it, guys. You put $130,000, $140,000 to get the house in the first place, and now you're pulling $150,000, $160,000 out. Basically, in that 5-year period, this would be an example where you could use the money that you've made to fund another investment exactly like the one that you made 5 years ago. So in 5 years, your money is essentially doubling. So every 5 years, your money is doubling, right? And then you can use, so if you turn one house and then it pays for your second house, and then those houses pay after 5 years pay for two more houses, well, now you can see over time how your returns are getting kind of ridiculous, right? So when you look at, there's a statistic where they show that the number one effect, or the number one cause of millionaires for decades has been through real estate. And you can understand why, because over time, you're getting really, really good returns on your money. Now, there is a second option in real estate that is going to either be more or less appealing depending on the situation that you are in, okay? The first kind of real estate investing that I just talked about is more of turnkey real estate investment, where you're buying an investment property that produces a cash flow and it appreciates in value and all this kind of stuff. That is the first kind of real estate. That's generally what I invest into, because I don't want to invest too much of my time. I want to just deploy my money and have my money make me money. Now, on the other hand, if you're kind of low on funds, you want to increase the amount of money that you have, then you can do what's known as BRRR. Now, if you haven't heard of BRRR before, BRRR is BRRRR, just a bunch of R's. And what it really means is buy, renovate, rent, refinance, repeat. Okay, that was a lot. So let me break it down. You buy a property that has some kind of problem, okay? But it's some kind of problem that you can actually fix, okay? And what you can do is you can actually multiply your money in that instance, because let's say you spend $50,000 on renovations, but it increases the value of your property by $200,000. Well, now you've gained $150,000 in cash because you've invested $50,000, but you've increased the value of your home by $200,000. So after you have renovated the property, then you are going to rent it at a much higher rate because the property is worth way more. Then when you go to refinance with the bank, you're able to say, okay, this $400,000 home that I pumped $50,000 worth of renovations into is now worth $600,000. So I would like to get a mortgage on the basis that this is actually appraised and valued at $600,000, which means you're able to collect the $200,000 out of the property as cash that you get to keep, which more than pays for your $50,000 renovation costs, and it actually funds the next BRRR deal. So BRRR deals are about creating money out of thin air, but they require more effort on your part because you actually have to diagnose what the problems are. You have to take a bit of a risk because there's obviously problems with this home. Then you need to get it fixed for a fraction of the price of what you're increasing the value of the property on. Now, to give you guys an example of this, the multifamily that I just bought, the 12-plex in my hometown here, the guys that bought it before me bought it 4 years ago for $875,000. Okay. Now they pumped in about, it was a real crappy property back then. They pumped in about $150,000 worth. I have no idea. I'm just speculating that they pumped in about $150,000 worth of renovations to the multifamily property. Well, now today, I just picked up this property or got an accepted offer on it the other day, about a couple weeks ago, and there was 10 offers on this property. So it went for over the listing price, and it sold for around $1.46 million. So they bought there for $875,000. They pumped in $200,000, which takes them to $1.1 million, a little bit less than that. And now they're going to make in profit $360,000 that they're creating out of thin air. So when they sell it, they get to keep all that cash minus, capital gains taxes, which are not very much, that they minus or deduct off of that earnings. Now, they came in and saw a problem. Nobody wanted to buy this multifamily property because it had a ton of problems. Nobody wanted to put the time in, right? They came in, they fixed the problems, and then I came in and saw a property that's fully fixed up, that's just turnkey, that I can just buy and it's just going to give me a return without me having to do anything. and I bought it as the investor. So there's two types of investment. There is the create money out of thin air, which is the BRRR strategy. And then there's the second way to make money in real estate, which is just the turnkey passive return. Now, this time I have a real estate portfolio of around $6 million, and it is all turnkey stuff that I'm just dumping my online income to. And I'm always looking for new deals in this field. But if I had more time, let's say I had less money, but I had more time, then I would be looking and focusing more on the BRRR and the fixer-upper side of the equation. So hopefully you got some value to that. You might be watching this video right now and say, Brennan, I don't have that much money. Well, you don't need a ton because you're putting 20% down. And if you buy a fixer-upper, you can find a property that really, is dirt cheap because it's got problems. You can go in, you can put 20% of the money on that. Lots of times, if you know what the repairs are that you need, you can actually get those repairs put on the mortgage, so you don't have to pay for them out of pocket. They go into the actual mortgage agreement too. And you can also, instead of paying a bunch of money for someone else, you could even get handy yourself and fix a lot of these problems yourself and save a ton of money that way if you have the time to do that. And for relatively cheap, you can get in on this. You only need one BRRR deal to give you a bunch of cash that will fund your next BRRR project. So just by doing this BRRR strategy, you could build up a real estate empire with almost none of your own cash invested. On the other hand, if you're on the other side of the equation, which is you have a bunch of cash, and you just want to make more money with it and invest it the right way, then you can do what I'm doing, which is more just get into turnkey stuff and have your money passively make you about 20% per year. Now, hopefully that video helps, guys. I don't know. Like I said, different people are in different situations, but maybe somebody will hear something from this video that will give them a nugget or an idea that they want to pursue in more depth. If you have any questions about what I talked about on this video, go ahead and put them in the comment section. I'm not going to create a bunch of videos about investment strategies because most of my videos are actually about how to make money and make capital in the first place. But after you make that money, you make that capital, or you have that money and have that capital, you want to find the best ways to invest it. And that's what I've tried to cover in this video. So thank you so much for watching this video, guys. Have an awesome day or evening or night or whatever's going on out there. And I will see you guys in the next one. Bye for now.